Financial instruments, IFRS 9, IAS 32, is a difficult topic because there's so much to learn, and basically there are 4 different chapters that cover that. And one of the topics that is always missed by people is the derecognition of a financial asset. So we are going to have questions like that. We have a company sold its account receivable to a factor, and the question is how to recognize that. And the company is going to recognize it as credit account receivable, debit cash received, and the balance and figure is going to go to P&L. But that is not how we should do that. Because for us to record this credit financial asset, we need to ensure that the recognition criteria have been met. There are 2 types of these criteria. One is when the contractual rights have expired. So, for example, you had accounts receivable, and accounts receivable were due on, let's say, 31st December 2025. And in the country that you operate, there are 3 years that you can use in order to sue the company if they haven't paid you. And after 3 years, you can't do anything. So this means 31st December 2028 is when we can recognize it completely. Now, the other principle would be that when the financial assets, risks and rewards have been transferred from the seller to the buyer. And we need to talk about those risks and rewards separately. So we're going to look for the word recourse. If we were told that this is a factoring agreement with recourse, this means that the factor, the bank, can come to our company and say that this very customer has not paid. Now, please reimburse us or pay. And this means, and you need to explicitly say which risk has not been transferred, this means that the risk of non-payment has not been transferred. Then you are going to challenge the scenario further, and you are going to look at the part that relates to late payment. So you will have something like that. The factor is going to charge interest the longer it takes the final customer to pay. You would need to take this part from the scenario and say it explicitly that the risk of slow payment has not been transferred. Please mind that you need to talk about specific risks, not just risk and rewards have not been transferred. You need to explain that. So this is how we need to recognize financial assets. If risks have not been transferred, then you cannot write credit accounts receivable, for example, or any financial asset. This means that you got cash, debit something, and credit will be your financial liability. There will be no profit and loss. There will be credit, financial liability. And that is how it works. So this is how financial assets derecognition is going to be tested, and most likely is going to be in the question where you need to talk about the impact on the financial statements. And in this case, if the company failed to recognize a liability, then this means that gearing artificially looks better than it actually is. And then we will talk about ethics, and I have a special episode on this podcast that talks about ethics. And if you want to pass the ACCA exam, it is important for you to understand what get tested and how, and this is what my course is about. So I will be happy if you join me. All the links, including the free trial period, are in the comments below. Bye!